What's good, everybody? We're gonna get this show on the road here in just a couple more minutes. Go ahead and send this link out to anybody that you think would find some value tonight. We're gonna go over a really solid training on how to effectively create a trading plan, and so highly encourage you guys to send this out to anybody that is already in the world of trading that you think could benefit from being here live. Of course, this will be recorded. I know we got a lot of people out in Europe that are currently sleeping and won't be here live, so it's all good. They'll be able to watch the recording. But yeah, in the meantime, man, help me out. Send this link out to whoever you think would benefit from being here live. All right, ladies and gentlemen, what's going on? Happy Wednesday. Or actually, it's not even Wednesday. I keep thinking I'm so used to like not doing a call until Wednesday, got Wednesday New York session tomorrow. Today's Tuesday. Happy Tuesday, everybody. Happy Tuesday. Trust you're all doing phenomenal and looking forward to tonight's training. And we got a really good one in store. This was something that I felt called to record mainly because of the fact that many people, as of recently, have been inquiring a little bit on trading plan creation. And I'm going to see if I can clean up my camera a little bit. There we go. I think it's maybe a little bit better now. But yeah, man. And this is something that I've talked about here and there on trainings before or on live sessions before, but I wanted to make a very coherent, easy to understand, and effective training. And this is going to be recorded, of course, and it'll be condensed into a, maybe 10 to 15 minute YouTube video that goes a lot more thoroughly into what it takes to make a proper trading plan. So super excited to be here. Super excited to dive into things. And drop in the chat real quick where you guys are tuning in from. Let me know in the chat where y'all are tuning in from today on this Tuesday evening. I know it's potentially Wednesday morning for some of you, right? I know it's 8 p.m. Eastern time. So we got, let's see, Australia in the building, amazing. Canada, Moncton, fantastic. Fort McMurray, the oil sands, Alberta, let's go. Love to see it, man. Love to see it. Canada represent today. Big Canadian squad over here and tapped in live. We love to see it. Cool, man. Well, let's not waste any time. Let's go ahead and dive right into things here. I'm gonna see if I can pop out this chat as well. Okay, amazing. There we go. Excellent. So Let me start recording this. So today's topic of conversation is really how to create a trading plan, a winning trading plan, how to actually go about it. Because the reality is, like, everybody knows or has heard about trading plans, but when it comes down to actually creating a trading plan, how do you do it? What are the things you should be including? What are the things that you should be considering to make sure that you are setting yourself up for success? All right. So today, again, we're going to be talking about how to create a profitable trading plan, how to create a winning trading plan. And there's really going to be three pillars that we're going to be diving into. All right. Three pillars that we're going to be diving into here today. And so let's not waste any more time. Let's go ahead and dive right into it. So first things first, okay. One of my favorite quotes is on screen, and you can see it at the top there, right? You can only build as high as your foundation is deep. So we have three materials to this foundation, which are currently on screen. Each of these materials, just like if you were to build a house, just like if you were to be building a skyscraper, a condominium, whatever the case may be, you're going to build a deep foundation made up of a few different materials. Most of it's going to be very, very sturdy materials so that it can sustain and hold up whatever the structure is going to be when it's built upon, that ground and that foundation, however high it's going. It has to be deep, right? You can only build as high as your foundation is deep. So the trading plan is really the foundation of trading. This is made up of three different materials, which we're going to go over in a lot more detail, but understand that a trading plan is your foundation. Without it, you can't expect to build to profitability. You can't expect to build a skyscraper, all right, if you don't have a foundation. So the first level, or kind of the base of the foundation, is risk management. Then you have your rules, and then you have your execution of the plan. And each level, you can see it's written down here, each level depends on the one below it. Okay. And if you skip the foundation entirely, everything above it's going to collapse. It's like, imagine building a house on sand. Good luck, Chuck. Okay. Your house is going to be wobbling and moving and collapsing in no time. If you go ahead and you build a foundation in that sand and you make it so that I don't really know how you would do that actually, but Dubai, the guys in Dubai figured it out. Okay. Building foundations in sand. I mean, literally, Dubai is built in the desert, but you got to have a foundation. You got to have something laid to be able to build effectively in sand. You can't just put stuff on sand and hope that it's going to stay in place. So, taking a look back at what it says here, each level depends on the one below it. Your rules and your trading plan, your confirmation checklist, and what we're going to get into when we talk about this, it doesn't mean really anything if you don't have proper risk management. All right. This depends on your ability to effectively use risk management. And your execution of a trading plan, or your execution of trades, depends on the rules you have set in the risk management. You can't expect to be executing trades effectively if you're not using proper risk management, or if you haven't established a plan around your risk management. So here we have a pyramid, the strongest structure in the world. Each level of this pyramid is dependent on the one below it. All right. And these are the three materials that we're going to be going over so that you can go out there and at the end of this call, build a really strong, sturdy mansion for yourself, a mansion of a trading plan. Okay. So, pillar number one, risk management. Okay. This is something that so many people do wrong. And I'm going to get into why in a second here, but understand that if you're using the same lot size every single trade, you're trading incorrectly. If you are using the same position size every single trade, you are trading incorrectly. I don't care who told you that that's the right approach. I'm going to share with you right now the facts. Okay. If you are expecting to be long-term, consistently profitable, your best approach and to set yourself up to win is going to be to define R. Okay. That is the first thing we're talking about on screen here. You need to define R. That is the amount that you're going to risk per trade. And it should be consistent, a consistent dollar or percentage. It shouldn't be a lot size consistency. It shouldn't be a trade size that's the same every single time. Oh, one contract, two contracts. No. Okay. Reason being, every single one of your trades, if you're taking trade ideas inside of our community, for example, all the stop losses, all the, distances are different. So if you're using the same lot size, the same position size every single trade, you're risking a different amount of money or percentage of your account every single trade. That is not what you want to do, okay? You want to think of this as, let's say, a revolver. All right, you got 6 different bullets. You want every single one of your bullets to be worth the same thing. It's like, imagine you're shooting at a target, okay? Now, some of your shots at the target are going to miss, or maybe they won't hit the head, right? The head gives you the most points. That's the trade that gives you the most profit on a week over week basis. But each bullet inside the revolver is worth the same. It has the same potential. And you know that, hey, if you miss with this bullet, if you miss on that trade, you lose on that trade, you're losing the same amount as the next 5 shots that you have in your revolver. Most people are not using a static risk every single trade. This is absolutely crucial. So make sure that you've defined what you're going to risk every single trade. Make it the same every single time. Choose a dollar amount, choose a percentage of your account, whatever you'd like. All right, if it's a percentage of your account, the dollar amount risk per trade is going to fluctuate as your account balance is changing. But maybe you decide to risk, 1 to 3% every single trade. Anything more than 3% of your account risked per trade is kind of aggressive. Okay, I know some people that risk 5% per trade. That's fine. I would say that's like a hard max, but ideally 1 to 3% of your account is what you should be risking per trade. So when it comes to position sizing, this is where you're going to calculate your position size, your trade size, your lot size to make sure you're not risking any more than what you've defined as R. Okay, so let's just take, for example, let's just say that you decide to risk $50 every single trade. R equals $50. All right. You're going to want to take the time to calculate your lot size, to calculate your position size so that you are risking no more than $50 on that trade. And ideally, you're risking exactly $50 on that trade. That way, if you, let's say lose 1 or 2 trades in a row, this is where the risk to reward ratios can really be in your favor. Now, what is risk to reward? For anybody that's new here, risk to reward is how much you're risking and how much you're looking to gain every single trade. Set a minimum risk to reward ratio for your trades. For me, okay, in my trading plan, it's 1 to 2 risk to reward, which means that every single trade I'm entering, I'm risking $50 to make at a minimum $100. Okay, that's a 1 to 2 risk to reward. I'm risking 1 to make 2, risking $50 to make $100. Okay. And as long as you keep your R consistent, the amount that you're risking every single trade consistent, you can actually be losing more trades than you're winning and still be profitable. And this is a huge, huge point that you can't look over, you can't miss. Most traders fail. We know this. This is the facts. 95% of traders fail. Something that allows you to be the 5% of traders that are long-term consistently profitable is making the rules so that you're more likely to win. This is one of the ways you can go about doing that. Trade where you're risking every single trade 1 to make 2 or 3, perhaps. Ideally, 1 to 3 risk reward is in my ideal scenario for all my trades. Bare minimum 1 to 2 risk reward, ideally 1 to 3. Now I'm risking, $50 to make $150 on a trade. Okay. So this is really the foundation of your trading plan. If there was like, and you could see in that diagram on the last slide, this is at the base. Risk management is at the base. Before we even get into strategy and rules and how to execute your trading plan effectively, you got to start with the end in mind and you have to define this for yourself. So really the only thing you have to focus on this slide is this, right? Think to yourself right now. Maybe you're watching this live or in the recording. Go ahead and write this down for yourself. Moving forward, what is the dollar amount that you want to risk every single trade that you are going to commit to because you want to be profitable, right? I think everybody here, drop a 2 in the chat if you're trading to make more money or if you want to make money trading. Okay, I should be seeing a whole bunch of 2s in the chat. All right. As long as you guys aren't falling asleep on me in the chat box. Come on. Come on now. Okay, there we go. There's the 2s. So define this for yourself right now. Don't wait until after the call. This is, if you're on this call, you're on this recording, define this for yourself right now. It takes 2 seconds. You know the account size you're trading with. If you're trading with a $100 account, maybe you decide to risk $5 a trade. Yes, that's 5%. Maybe it's a little bit bigger than, what I think the ideal is, 1 to 3%, but it's $100. Like you gotta, even with the smallest trade size, like it's going to be tough for you to risk anything less than $5 with the smallest, account size, which I think is actually $50. But define this for yourself. Okay. Define R for yourself. Then make sure your position size calculating every single trade before you take the trade. It's very, very easy to do. I have videos on how to do this inside the community on my YouTube channel as well, which you can find, which you can access. And it's very, very straightforward. If you're trading on MetaTrader 5, which most of you are, it's very simple. From the chart window on MetaTrader 5, you can drag your stop loss and take profit levels, and it'll tell you at the bottom how much you're risking and how much you're looking to make, depending on what your lot size is. So if I have my R set to be $50, I'm just going to increase or decrease my lot size to make sure I'm not risking any more than this, and ideally as close to $50 as possible. It might be, $49.80 or something. Perfect. Amazing. Okay. So make sure you're calculating your risk, and then just write in your trading plan, what is your ideal minimum risk to reward ratio every single trade? Because this is something that's going to help you to determine what trades you're taking and what ones you're not. You might have rules on, okay, these are the things I'm looking for to justify taking a trade. But if there's not the minimum risk to reward ratio met, I'm just not even going to consider taking the trade. So again, this comes before any of the confirmation checklist stuff and rules that we're going to get into on the next slide. So this call is being recorded, yes. So define this for yourself, okay? 1 to 2 risk to reward ratio is my minimum personally. Maybe for you, it's a 1 to 1 risk to reward. That's fine. You just have to be winning more trades than you're losing to be profitable, okay? But if you're trading with a 1 to 2 risk to reward ratio, you can actually be losing more trades than you're winning and still be making money trade over trade, week over week, month over month, because of the fact that, hey, you're not going to win them all, but you know that, and you've set the rules so that you're in a position to be profitable, even if you're losing more trades than you're winning. So number one, define this dollar amount you're going to risk or percentage amount you're going to risk every trade. Number two, commit to calculating your position size to make sure it is congruent and aligned with whatever you define as R. And number three, write in your trading plan, what is the minimum risk to reward ratio you are going to look for every single trade. This is going to help you sift through and find the quality setups instead of just taking every single trade that you think is a good opportunity. Okay. So that's the pillar number one. Pillar number two. All right. In moving forward. Okay. Whoops, skipping ahead. Here we go. Rules. Let's talk about rules. All right. The next step after you've identified and kind of defined your risk management foundation, the next layer in our foundation are our rules. So these are the WWH, is just an abbreviation for what, when, and how. These are the what, when, and how in your trading plan. So number one, what? What are you going to be trading? Okay, what you trade is completely up to you. What I would suggest is that you're not trying to trade everything on your trading platform or your broker. All right, choose 2 to 3 assets max. Okay, this is the best thing you can do to start out with. Master those 2 to 3 pairs. Look at only those 2 to 3 pairs, those 2 to 3 assets. It's better for you to focus on the same couple or handful of pairs, 3 max ideally, because you're going to start to develop a relationship with those pairs. What I mean by that is, imagine this, okay? Imagine you're in the dating scene, okay, and you got a roster going, all right? You're going on a different date every single day with a whole bunch of different partners. How deep is the relationship going to be if you just go on one date with 20 different people? It's probably going to be pretty surface level. Imagine you just choose 2 to 3 people and you go on a series of dates over the course of a month. Your relationship and your connection is going to be much deeper. And from there, you can choose your wife or your husband. Well, not, obviously not right away, but metaphorically speaking, in the charts, you're going to have a favorite pair. You're going to have a favorite asset. You're going to have an asset that you decide to marry, so to speak, or favor a lot more than even the other 2 or 3 pairs that you're seeing once in a while. Okay. So kind of a funny analogy, but it's true. You have to build a relationship over time with the same assets. And in order for you to build a strong relationship, you have to be looking at and focusing on the same thing over and over and over again and not scattering yourself. I find so many people, and myself included, I was very, very guilty of this. I used to go through all the pairs on a Sunday night at the beginning of the week. And guess what? Because I was never focused on the 1 or 2 setups that actually made the most sense of the whole ton that I went over, I was focused on all of them. I would miss trades. I would miss trades and I would end up over trading. So I would be taking the trades that didn't make as much sense as the 1 or 2 bangers that I maybe overlooked because I'm focused on going through 25 different charts, 25 different assets at the beginning of the week. So really less is more. Okay. 2 to 3 assets, focus on those. If you're on a Sunday night looking at these 2 to 3 assets and you're like, man, I don't know what to do, there's nothing that's jumping out at me, that's fine. Come back tomorrow, right? Sunday night, when I do market outlook, for those of you that are on my sessions, you know this. Sometimes I'll look at the charts, go over the pairs that I look at with you guys, and there's 4. The only reason there's 4 is because 2 of well, they're all kind of correlating, but Euro USD and GBP USD are directly correlated. So really the ones that I'm looking at are gold, Bitcoin, EU, and GU. That's the 3. GU and EU obviously, have a relationship. It's technically 4 pairs, whatever. Those are the same 4 that I look at every single Sunday with you guys and every single Wednesday with you guys. I'm not looking at anything else unless I have like an extra 30 minutes on the session and I'm like, okay, who wants an opinion on what I think the next, move is going to be on NASDAQ or something. Right. But I'm focused on the same things every single day that I'm on the charts every single time I'm doing a live session with you guys, with some exception. Okay. So that's the what. Okay. When, number 2, very important to identify and clarify this. Absolutely crucial to do this. And here's why. If you decide to trade just whenever you feel like it, you're going to get whenever you feel like it results. So don't trade whenever you feel like it. Schedule yourself. Okay. Create a schedule, a consistent schedule that you can follow and that you can align yourself with every single week. Ideally, it's the same schedule every week, but hey, I get it. Sometimes I'm traveling, so I can't trade the same exact schedule every week. I got to sit down on a Sunday night and think, okay, I'm taking this flight this day. I got to move things around. I can't do that live session on Wednesday. Okay, I'm going to cancel live session or reschedule it. And then I'm going to be doing that live session and trading live on a Thursday, let's say, for example. So my plans they're fairly consistent, but I do obviously have weeks that are a little bit different, that look a little bit different. For example, in June, I took 3 weeks off trading. I wasn't trading at all during those 3 weeks, right? So you got to obviously create a schedule for yourself. And ideally, it's something you can stick with consistently, but define the trading sessions, number 1, that you're going to be trading. Ideally, it's just one: New York session, London session, Asian session. Just choose one of those 3. You don't need to trade more than one of them, really. If you decide to, that's fine. New York and Asian session, maybe, or whatever. All right. And then also the days of the week you're going to trade. So for me, I look at the charts on Sundays. I'll set limit orders or pending orders on Sundays. And then really the only day that I trade throughout the week typically is Wednesday when I'm with you guys. And then I'll also look at the charts and potentially take setups on Tuesdays and Thursdays. Monday, which was off schedule, but yesterday actually ended up taking a trade. I shared it in the trade room, and that was a nice little trade. It was a TP2 trade on gold. But ideally, again, you're setting the schedule and following the schedule to a T. All right. So for me, I'm looking at the chart Sunday and setting pending orders. I'm not usually live trading on Sunday. And then Tuesday, Wednesday, Thursday, those are the days that I'm focused on New York session. I'm not looking at London session. I'm not looking at Asian session. New York session, one trading session, those days throughout the week. All right. These are things you want to define. You can take a second while I'm giving you these deep explanations to identify and clarify this for yourself live. All right. If you're on the recording, you have an advantage because you can pause, define these things, and then continue. Then we get into the how. The how is, I would go as far as to say, less important than this. Everybody's focused on the strategy. Everybody's focused on the entry models, the confirmations for taking trades. And yes, those things are important. I would go as far as to say when you trade is more important. Because if you're not trading at a consistent time or a consistent session, and maybe not even trading the same things over and over again, you're not going to benefit from the entry models or confirmations that you choose to set for yourself consistently. It's not going to be consistent. So in a business, right, you have a plan that you're following. You have a time you got to clock in, a time you got to clock out. Okay. You have meetings this time of day. You got your lunch break, and then you've got some more meetings going into the end of the day. All right. When you're doing these things is important in your business, just like when you were trading is important for your trading. So then the how, which is still important, and it's obviously in here for good reason, is you only are entering the market if certain things are present, which means I'm not going to look at the chart and just take a trade because I feel like it. It's if X, Y, Z are present, then I'm going to take a trade. So defining the how you're going to actually enter the market, this is not how to trade. This is how you're going to enter the market. That's what the how is referring to here. It's the entry models that you're looking for that are going to justify how you're entering yourself into the market. So you're going to be able to build a confirmation. I know there's a spelling error here, but a confirmation checklist of conditions that must align before you take any sort of a trade, before you pull trigger on that particular trade. So, and I'm going to get into this in a few slides, some of the entry models that I use in particular to go about taking trades and entering into the market, because I'm not trading every single day and not every setup is going to be worth executing. So I have a checklist. I have things that I'm looking for. I have entry models that I'm following before I take any sort of a trade. So this is the second layer of the foundation. And the final layer is execution. Execution comes down to your ability to follow the plan that you've established for yourself. Realistically, like if we're talking about just the plan on its own, rules and risk management, that's all that there really is. But the thing is, even if you've established rules and risk management, if you fail to execute effectively, if you're not following the rules that you've set for yourself, if you're not following the risk management that you've set for yourself, what are you doing? There's no execution. There's no follow through. So the reality is most traders are executing trades daily, but effective execution follows rules and produces real results over time. All right. What is execution referring to? Well, it's your ability to follow a plan and to execute on a plan. It's not just trading execution. Okay. We're not talking about, oh, I'm market executing a trade. That's what execution means, right? I'm executing. No, man, it's your ability to execute a trade, not just execute on a plan, not just execute trades. Now, something that can help with discipline and following a plan is journaling. Some people have been, it's funny, I've been in a couple different in-person events, and some speakers have spoken about trading plans and and journaling in particular. And I'm obviously there, right? And they say, now I know Donnie doesn't journal as much anymore because I posted a reel talking shit about journaling. Journaling is still important, okay? Just because I've been doing this for 8 years and don't journal the same way I used to back in the day doesn't mean that you in your first year should not be journaling. All right, am I setting a bad example by not journaling? I don't think so, but maybe I am. For somebody that's brand new, don't do what I'm doing now. Do what I did when I started. I was journaling every single trade religiously when I started. Okay. What the trade looked like before, during, and after, how I was feeling before, during, and after. These are things that are going to help you remain accountable in following your trading plan. And it can be tremendously supportive to not trade as much. Again, less is more. You're focusing on quality setups. All right. And you reflecting on your trades is going to give you insight, but also you documenting and journaling your emotions, maybe some screenshots before and after, which aren't really even the most important part of journaling. It's how you feel, and being aware, increasing your awareness of how you feel is more important. But you in the journaling process, it's tedious to journal. Like, don't get me wrong, it's tedious to journal. And that's why if you really commit to journaling every trade, no matter what, it's going to force you, not force you, but kind of cause you to trade less, because you're going to be like, man, like I'm contemplating taking this trade. I feel like I might be forcing it a little bit. And then I'm going to have to go ahead and take 15, 20 minutes to journal this one trade later. Anyways, I'm just going to not take the trade. Okay. So it's something that's reinforcing you because it's holding you accountable. It's just a good habit to have in general, but also it's tedious. And so you might just not execute as many trades because of the tedious nature of actually journaling. It's kind of interesting. So yes, I'm in a reel saying that journaling is, not mandatory, and it's not. You can be profitable and not journal. But when you're starting out, journaling is absolutely, absolutely recommended. I highly encourage it. And it's something that will benefit you. Absolutely. The compound effect. Consistent execution of a plan will unlock the eighth wonder of the world, which is compound interest. You know what will block you from tapping into the eighth wonder of the world? You might be the most knowledgeable, proficient technical analyst out there. If you don't follow your plan, if you're not consistent with your risk, if you're not consistent with the trades that you're taking, following the rules that you set for yourself, you will never experience compound interest in your account. You will never experience the exponential potential that we have in trading. Warren Buffett says it's the eighth wonder of the world, by the way. That's not just me. That's like, the goat of goats when it comes to investors. The compound effect is really the eighth wonder of the world. So only with effective execution of a plan consistently can you actually take advantage of this wonder. Can you actually unlock the eighth wonder of the world, which is compound interest? And compound interest illustrated is this. Okay. Let's say you had $1,000 account. All right. You are aiming for 3% weekly. You might look at this and say, Donnie, this isn't reasonable and realistic. I would look at you and I would say, I made 3% yesterday. You're telling me that 3% a week is unreasonable. You're uneducated. That's what I would say to you, respectfully. Okay. We had 2 winning trades to start the week, gold and euro. Both of those trades were 1 to 2 risk to reward ratios, risking 1% to make 2%. That's 4% on a Monday. The TP of Euro USD hit today. So technically, we had 2% yesterday, 2% today. I could be done for the week if that's my goal for 3%. So if you're risking 3% per trade, I mean, you're up 12% on the week, right? Risking 3% to make 6%. That's 2 6% days back to back. So to say that 3% is unreasonable every week is just wrong. It's not true. It's not the case. This is conservative. All right. What's difficult is you actually following your plan consistently for a full year. What's appealing and incentivizing is this. If you were to just dedicate yourself to trading effectively for a full 12 months, averaging 3% per week, some weeks you're going to lose. Some weeks you're going to have break even. So this is an average expectation. You could have from $1,000 a ending balance of about $4,300. You might look at that and be like, Donnie, that's only like $3,300. It's not that much money, right? Total earnings 33, 34. It's not a lot. Sure. But it was from you pressing a button on a phone a couple times a week, and you started with $1,000. That's a 300% return. What if we did this with $10,000? Might be a little bit more significant for you. Okay. You have a $10,000 account making 3% a week. Even if we took this and cut it in half, it's still a significant amount of money by the end of the year. That's a $30,000 growth. Taking your $10,000 account to $43,000. Okay. So this is what's possible when you actually tap into the eighth wonder of the world. And this is what the chart looks like, right? You start with $1,000 month over month. You're seeing these increases. It takes you 6 months to double your money. Guys, we're 6 months into the year. We're 7 months, almost 8 months into the year now. Imagine you just were disciplined and followed your plan and actually had a plan. Maybe you don't even have a plan. That's totally fine. That's why you're here. But imagine you just followed the plan for 6 months. You already would have doubled your money from the beginning of the year. Guys, ETFs. I went to a major event on Saturday, and the talk of the town was ETFs and stocks and indexes and all these different investments that are long-term, really, really good plays. And I'm talking to this guy, and he's like, "Yeah, we aim for 12%." And with our team of investors that are overseeing these ETFs and everything, that's usually what we do. And I said, oh, like 12% per month or per quarter, per year. And he's like looked at me like I had 2 3 heads. He's like, per month? Per month? No, this is per year. 12% per year. And I kind of chuckled to myself, and he's looking at me weird, right? I'm a day trader. Guys, 12% in a month is what you're doing if you're doing 3% a week. So that's taking a full year of potential gains, working with these investors that are doing and managing your money for you, which is not, I'm not saying it's a bad idea or a bad thing to do. It's good to do. I have had long-term investments as well. But it's taking that full year and condensing it to the return that you can receive in a month if you just follow a plan, create a plan, and are disciplined with your execution. If you just followed the rules, this is something you can tap into right here on screen. Now, what you do leaving this call is up to you, obviously, but this is what's possible. Okay, and if you've been trading for a while and you've been learning with me inside the community, whether it's from my sessions or from other educator sessions, guys, you know 3% a week is laughably easy. It's really not that difficult. We are the ones that make it difficult by not following a plan or not having a plan or being sporadic with risk management or thinking, you know what, on this trade, I'm full porting, as they call it on social media. I'm freaking full porting on this trade. Why? Because I feel unsatisfied with my financial position, and this trade has the potential to turn it around. It's like the worst mentality you could possibly have, and you'll never tap into the eighth wonder of the world, period. And I wish you all the best. Good luck, Chuck. Okay, it might work for you once in a while, but guess what? You're going to reinforce a negative habit, do it again, blow accounts, blow accounts, blow accounts, and never, ever get to see something like this. Crazy. This guy couldn't even say that he could do 12% per quarter with his investment firm. Only per year. We're looking at this, and the effective rate of return, if you just follow the plan that you set for yourself, is 300% in a year. Is it sustainable long term? Well, if you are consistent in following your plan and you are a good analyst and you have a solid confirmation checklist, yes, this is something you can consistently do over time. And realistically, there are firms that could create these types of returns. It's just this number is less because they're more conservative with the risk. They're risking, instead of, let's say 1% per trade, they're risking 0.25% per trade. Okay, so it all comes down to your risk appetite as well. But this is just an example with $1,000 account. Moving forward, now we're going to talk about creating the perfect checklist. And this is where it gets kind of exciting. So the 3 models that I use personally, okay, I can't choose for you what you decide to, execute or put in your trading plan. But I'm going to give you guys the 3 that I use. And if you want to use the same 3, amazing. Let's trade the same way. I'm down, right? I'm down. And I talk about all of these on my sessions. These are the only things that I really focus on explaining and overviewing in my sessions. But this is the how. How am I entering into the market? Well, these are the 3 models that I use. So you have the order block entry model, the fair value gap continuation model, and then the IFVG entry model. Now, today, this call is not focused on how to trade each of these models. Okay, I just have screenshots to quickly show you guys what each of these models look like and very briefly touch on them. But I have lessons inside Primeverse 3.0, the brand new Smart Money course, that goes in great detail on every single one of these entry models. So leaving today, that's your homework. Okay, go through lesson 5 if you want to learn the order block entry model. Go through lesson 7, 8, and 9 in the Smart Money course on Primeverse 3.0 if you want to learn the fair value gap continuation model. Go through lesson 10 if you want to go through the IFVG entry model, the inverse fair value gap entry model. Okay. But order block entry model, it's very simple. This was the exact same trade that we took on Sunday. This was a prime example of a order block entry model. You had this last up candle prior to the down move, which is a buy to sell motion in the market. Mitigation is the action of major banks and institutions returning to this area to close out previously open buys, to then bring the market lower and attack liquidity, which is exactly the trade that we took this week that we talked about on Sunday. And textbook setup, right? Sniper entry, 0 drawdown, rate to take profit, 1 to 2.5 risk to reward ratio. So if you're risking $50 on this trade, okay, 2.5 times would be, what is that? $125 from that trade. So you're making 2.5 times what you risked on that particular trade. Banger trade, great trade, right? Clean, concise. Shout out to Jordan for helping me announce when TPs were hit and the trade was activated and everything. Appreciate you, bro, for doing that. Anytime you're able to do that, I would greatly appreciate it. But that's the order block entry model. Then we have the fair value gap continuation model, which is basically whenever you have an imbalance in the market, right, a fair value gap in the market, you anticipate price to eventually return to it. So here we had liquidity resting above the fair value gap. Okay, we end up seeing a sell to buy motion down into the fair value gap, filling it. Ideally, you're taking your entry off the middle, the 50%, which is this dashed line of the fair value gap. Stop loss beneath this low. Looking to target at the very least a 1 to 2 risk to reward or some liquidity. Well, guess what? This is a 1 to 4 risk to reward ratio targeting the first area of liquidity. And you'll notice that the other areas of liquidity that also got swept are way up here, and we didn't even draw the risk to reward ratio up to there. This was like a 1 to 7 risk to reward ratio. It's like, imagine you're risking 1% to make 4% on a trade, or 1% to make 7% on a trade. That's what we're talking about with these entry models. Very effective, great risk to reward ratio potential on all of these. And then you have one of the more viral entry models in the world of day trading now, and that is the inverse fair value gap entry model. This is what I execute mainly on smaller time frames. And we have an indicator that we created earlier this year that everybody has access to inside the free community that gave this setup. This is the exact setup that I took yesterday on Monday. All right, we had an inverse fair value gap, which is basically just a fair value gap that gets created that then gets closed above and kind of invalidated. It's like, imagine you had a fair value gap right here, okay? And you're anticipating price to return to it and bounce off it for a fair value gap continuation model. Well, an inversion is basically just when price, doesn't respect it and we trade through it. All right, that's what an inverse fair value gap is. So here we had an inverse fair value gap. The indicator gave entry and exits as well as stop loss. And this was a very, very easy 1 to 2 risk to reward ratio trade yesterday on Monday. Very easy. And I did hold a small runner, but this ended up flipping and going lower afterwards, because I talked about that in the trade room, in the chat box on Telegram. But those are the 3 entry models that I use. So you want to go and you want to learn each of these entry models. They're very, very easy to learn. Just go watch the videos that I have inside the course content. I'm not going to, take any more time on today's session to discuss these. So in recapping, you have risk management, you have your rules, and you have your execution. All right. You have these 3 materials that you are going to build your foundation. Your trading plan is your trading foundation leaving this call. And ideally, you actually made part of it while you were on this call. All right. The unwavering foundation that sets you up for success. That's what we're talking about when we're talking about risk management. Okay. The rules and how you're trading and the execution doesn't matter if you're inconsistent with your risk management. So consistent risk on your trades over time is the key. Rules, you want to have a clear framework that guides your every decision, right? So what am I trading? When am I trading? And how am I trading? What are the entry models that I'm trading? Define those things, write them down, white paper, blue ink, not on your computer. And one thing you can do is you can review your plan daily, print it out. Okay. You could have a checklist like this, and this. If these are present, boom, I'm going to take the trade. Okay. Print it out, have it visible at your trade station. If you don't have a trade station, you're like, oh, Donnie, I just press buy or sell on MetaTrader 5 when I feel like it, out and about on my phone. Stop being a doorknob. Try to set up a trade station, man. Trade from the same place every time you're trading. Okay. And then print out your plan and put it somewhere that it's in your peripheral vision at all times. This is how you really, this is like, like a cheat code to get into your subconscious mind. Because even if you're not consciously paying attention to it, it's there, it's in the background. And then when you do have to think about, wait, what did I put in my plan again? Oh, yeah, let me go and take a look at it and I'll see it right there on the wall because I printed it out. I have charts that are printed out that are on my wall right here that I can look at every day, anytime I'm trading. Reflect on your trades and trust the process. All right. Your execution. Okay. I have a little quote here. Long-term consistency beats short-term intensity every single time. This is with any habit. All right. You might get inspired to start reading or going to the gym one day. You doing that long-term consistently is what's going to tremendously beat you trying to do a whole bunch all at once over the span of a week. Like trying to finish a book in a week versus reading one page every day. Reading one page every day will beat you every single time. I know it sounds crazy, like, Donnie, I could read a book in a week if I really put my mind to it. And I would say, oh, really? Okay. How much do you read right now? I don't. You'd be better just reading a page a day. And it's the same thing with trading. Trade the same way every single day that you're trading. Don't switch up your execution. Okay. And do this ongoingly, perpetually. If you can commit yourself to doing that, I can guarantee you 1 year from now, you're going to be more profitable than you are today. Guaranteed. Commit to your plan and follow it religiously. All right. Treat it like, your second Bible. Okay. Your trading plan should be your second Bible. Always keep your main Bible, the first one, the actual Bible. Your trading plan can be your second Bible, the other one that you look at every day, that you read every day, that you follow every day. All right. The market rewards the patient and prepared. So I have an exercise for you guys. Now, this is something that I want to do with the last 5 minutes on this call. And it's important because you could go through this entire training, all the training that we just delivered over the past, 40 minutes or so. And none of it actually matters or will even potentially get executed for you leaving this call unless you've done what's on screen right now, which is defining your why. Why are you actually doing this? Why are you trading? Okay. What is the purpose of you on this journey? What is the purpose of you being on this journey? And so there's an exercise that I want to do, and I want to encourage you all to do this with me in real time over the next 5 minutes. And the exercise is called the 101 Dreams exercise. I'll never forget the first time one of my mentors did this exercise with me. Number one, it was more extensive. Okay. The actual way you're supposed to do it is, normally you'd have to write out the numbers 1 through 101 and fill in as many of those numbers as you can in 20 minutes. It's actually a good challenge. You have 101 blank things that you need to fill in with all the things you want, all the things you want to do, all the things you want to accomplish. If money wasn't an object and you could do whatever you want, literally, you have to try and fill in as much as you can in 20 minutes. It's actually a really, cool exercise. I think I got like 30 my first time doing it. In 20 minutes, I could only think of 30 things. It's a challenge your first time doing it. But for today, we're just going to do it for 5 minutes. So This is the exercise. Okay. You don't have to write down any numbers. Just get a piece of paper. All right. Get a piece of paper right now. Actually do this. Don't do it in your phone. All right. If you're out and about and you can't do it right now, that's fine. But I would encourage you to do this when you are able to. Here I have a notebook. It's a pretty cool notebook. It's got a phone holder. Got it for free at the event on Saturday, along with this pen. And I asked her, hey, has this got blue ink? She's like, oh, I don't know. How do you not know what color the pen you're giving out from your company? Like, how do you not know the color of your... Anyways, she scribbles it. She's like, oh yeah, it is blue. I said, amazing. I love blue ink. I'll take two. And she's like, okay. And she gave me two pens. But get a piece of paper, get a pen. And for the next 5 minutes, I'm going to put on some music. And I want you to just write, focus on writing, be here now, and identify what it is that you want. What do you want? What do you really want? If money wasn't an object, if you had zero limitations, what would you have, be, do, experience, remove any and all limitations, write without any hesitation, as many things as you can over the next 5 minutes. I'm going to put on some music and we'll do this together right now. And for the people that are jumping off the live session, I wish them all the best. But this is the stuff that really, is where the rubber meets the road. Okay, it's the things that you least think have any relevance in trading that have the most relevance in trading, right? How you do one thing is how you do everything. So I want to make sure that you guys can hear this in the chat. Let me know if you're able to hear this music. Should be good, right? Amazing. All right, for the next 5 minutes, I'm going to put on a timer. In the next 5 minutes, I want you to write down what you would have, be, do, if money wasn't an object, if you could have absolutely anything you want in the world. Do this exercise starting now. 5 minutes on the clock. When this goes off, we'll stop writing. That is time. That is the 5 minutes up. Cool. How was that exercise? Did you guys enjoy that? It's a very beneficial exercise to do. So maybe there are some things on this list that you feel really called to focus on. There's something that you really, really want on this list. For me, in 5 minutes, these are some of the things that I got. Okay. I was nonstop writing for 5 minutes straight. Just thought, thing, material item, car, house, personal chef, personal butler, private jet, brand deal with Shake Pay. I'm just reading a few of them. Personal cleaner, speaking engagement with Jen, meet Kevin Trudeau. Well, I've actually met Kevin Trudeau already, but I just was writing. My hand is a little bit sore. There's no blue on my hand yet. I'd have to write a little bit longer. But this exercise is really powerful because it expands your mind and it actually reveals just how much limiting thinking and beliefs that you actually have. If you have a small, like if you do this for 20 minutes and you have less than 50 things, you have a lot of limiting beliefs, right? You don't believe that you can accomplish very many things. Your mind is not expanded to the potential of what all is yours for the taking. The whole purpose of the exercise is to remove limitations. It's to expand your mind. It's to get you thinking bigger. It's to get you dreaming. It's to get you back in that childhood state of using your imagination. You can do whatever you want. Usually, I didn't have this on my list this time. Going to outer space is almost always on my list. And you might think, well, Donnie, that's like an insane. Why would you write that down? Because I want to go to outer space at some point while I'm alive. That's genuinely something I want to do this lifetime. And I will do this lifetime. I don't know how. It's not like at the top of my priority list, you know. But in doing this exercise, it's a really powerful exercise. So again, just ask yourself, why are you trading? What is the purpose of you trading to begin with? And if you can focus on that, if you can hold that, near and dear to your heart, that's what's going to keep you going. That's what's going to motivate you to actually follow the plan that you're going to create leaving today's session, or that you started to create while you were on today's session. And so with that being said, that is the end of today's call. For those of you that are seeing this on the recording, which is being posted on YouTube, let's connect. Be sure to like, subscribe, all that good stuff. If you enjoyed the video, you can actually join our free community by scanning the QR code on screen, or you can check out the link in the video description. If you're here on the Zoom call live and you're maybe on from your phone and you can't actually like pull up the the QR code, you can't take a picture of the QR code because you're on from your phone. I'm going to drop it in the chat box. If you're not already inside of our free community, that's the link that you can go ahead and join through. It's going to bring you to my beacons page, and you'll see the trading community option to join right here. You can learn about our amazing community called Primeverse and our partnership with Primeverse. Our community is called Revolt Academy, and we're happy to have you a part of it. We do a lot of education, a lot of courses, a lot of daily live trading and trade ideas, AI tools, scanners, a whole nine yards. So there's more information on the page. You can go and check it out if you feel called to. But with that being said, ladies and gentlemen, hopefully you enjoyed the session today. I would highly encourage you to do that 20-minute exercise of what we just did for 5 minutes. Set the timer for another 15 minutes. Just keep writing, keep identifying what you want, keep thinking big. And hopefully you got some value and some tangible takeaways from today's call. But with that being said, much love, everybody. We'll see you all on the next live session.